Pimco bond guru Mark Kiesel says buy a house now. In a recent research note, he writes, quote, though I can't predict when U.S. housing prices will bottom, I can say the outlook for U.S. housing stocks looks considerably healthier than it did 6 years ago when I sold my own house and moved into a rental property. Wow, I bet you wish you had done the same. Well, I'll tell you what, Mark joins us now from Pimco's office in Newport Beach. Mark, thanks for being here with us. Let me ask you right off the bat, what's changed?
Well, I think what's changed is on the supply side, you have a lot less houses in inventory. Banks are now healthier. They're lending again. And on the demand side, the big thing is that prices are down 34% from the peak 6 years ago. And you see mortgage rates now at 4% or less. And finally, the Fed is basically reflating, which should help housing.
Well, it's certainly a persuasive argument, but why can't prices fall another 10, 15, 20%?
Well, I think they could. I mean, you've got a shadow inventory out there, which is pretty significant, and credit standards are tight. But if you look at housing relative to other markets internationally, U.S. housing is very cheap. And if you look at U.S. housing price to income, price to rents, it's looking very attractive again. So I think the valuation, both absolute and relative, will start to bring in, homeowners back into the market.
Well, it sounds like rent might be very key, Mark, because is it right that what was really kind of the trigger for you is when your own rental price went up by 10%? That's when you said, wait a minute, maybe I should consider buying a home again.
Yeah, that's a good point. And last time they tried to increase my rent 10%. And we follow companies all over the United States. And basically the largest landlord in terms of apartments, Equity Residential, is increasing rents on average about 6%. In major cities, it's even higher. So clearly rents are going up.
As you go through the process of actually getting a mortgage, how is it different now versus when you were getting a mortgage 5, 6 years ago?
Well, I think that's a big change, and that's why there still are headwinds to the sector. When you were looking at mortgages 6 years ago, you basically didn't have to put too much money down. Today, there's very thorough underwriting standards. You have to put at least 20% down. And I think the big obstacle, and this is why homes are falling through escrow, is the appraisals are much more difficult now. They're being more conservative in terms of underwriting.
Well, what about, Mark, just tell us about your own experience. I mean, did you end up buying a house that was about the same size as when you sold it? Did how did you find the supply? I mean, tell me a bit about your experience.
Well, I had owned for basically 8 years, from 1998 to 2006. I bought a second house in 2004, basically upgraded, do what most people did. Owned it for 2 years. It was up about 20%. I felt like housing would fall, ended up selling it, rented for 6 years. The house I bought is in roughly the same neighborhood. It is a little smaller. But my estimate is that the price I paid is probably around 35% lower from peak. So I feel like I got a good deal. Did
you rent a single-family house, or were you renting an apartment, or what were you doing?
No, I rented a small apartment. You know, I didn't really care too much where I lived, so basically it was just housing. But I think the big key was that when I sold my house in 2006, I felt like I could earn high single-digit, even double-digit returns in the markets owning financial assets. I think the big key now is that real assets look more attractive today relative to financial assets. You've got TIPS yielding negative real yields out to 13 years. You've got the Treasury 10-year at 190. To me, housing relative to financial assets looks much more compelling now than 6 years ago.
Well, you know, key point here, as a matter of fact, we had Michael Croft of Philadelphia Investment Partners with us just last week. He made the comment, it's similar to what you're saying. He said it makes sense, given where bond yields are, to actually sell your bonds and go out and buy rental buildings and treat effectively the rents as coupons on bond payments. Are you doing anything like that at Pimco?
Well, we're owning non-agency mortgages, so our mortgage team who follows that is very, very much focused on that. We do see attractive rental yields in certain areas of the country, and our ownership of non-agency mortgages reflects that, and also our overall view that housing is close to bottoming.
So, Mark, normally when housing bottoms, you want to buy every consumer-related segment of the market. Do you buy into that? Do you think we should buy the retailers, the home builders, all the equity plays on the housing market bottoming? Does it work the same way this time?
I don't think it works the same way this time. And the reason is that we still have a lot of debt. And I think the consumer still has a lot of headwinds ahead of it. There's also this big uncertainty over what's happening fiscally with the fiscal cliff. So I don't think the consumer is going to come back the way they typically come back in most recessions. There's too much debt. And if you look at the housing starts numbers, you know, they're basically half what we typically see coming out of recession. That's basically a function of a subpar economy and too much debt.
Hey, Betty, you.
Well,
I don't want to interrupt you.
No, that's all right. I was just going to ask Mark, though. I mean, you know, given that this is, and you know, a lot of people have said this is sort of a once-in-a-lifetime opportunity with rates this low and the housing market haven't fallen this much. Mark, would you consider buying a second home? I mean, is this now a time to really, you know, gather your real assets?
Well, unfortunately, I work a lot at Pimco, and it doesn't give me a great deal of time outside of work. So I'm too busy managing clients' money to focus on any of that right now. But if I had the time, I think.
Would you recommend that?
I think if you had expertise in basically being a landlord and dealing with tenants, then yes, I would recommend it, but not for me.
Yeah, not for you, not for me either. Before we let you go, just a quick thought. How long do you think it'll take before all that excess inventory, call it 4 million homes, is absorbed and we're back to where we were, and it's no longer the new normal at Pimco, but the old normal?
Well, I think the new normal's with us for the next 3 to 5 years. That's just a fact. In terms of the actual housing market, you've still got a fair amount in shadow, about 4 million. You've got 2.3 in existing, and you've got 144,000 in new homes. The reality is that's a lot better than it was even 2 years ago. So it's getting better, but there's still very high levels. So this is why I don't think we're going to take off again, why the consumer still faces headwinds. But then again, I think relative to other places you can put your money, hard assets like housing don't look so bad.
All right, Mark Kiesel, congratulations on your new home purchase and calling